This is Duke University.
Each quarter, Duke University and CFO Magazine surveys thousands of CFOs around the world. This quarter was the 70th quarter in a row we've done it. 1,200 or more CFOs responded this quarter. This is from the US, from Africa, from Latin America, from Asia, from Europe. Well, in the United States, the optimism CFOs have about the United States economy, it's right at the long run average. So for many quarters in a row, we had been below the average. We're right at the long run average right now. In Europe, optimism is actually up a little bit. Now it's still kind of low, but it's improving, meaning that we've bottomed out in Europe. So those two things are good. On the other hand, in the emerging economies, we're seeing a different pattern. We're seeing in Asia, optimism fell, actually below the US this quarter. Africa, optimism was already low and has fallen a little bit more. Latin America, most optimistic region in the world, but optimism has fallen. So in the emerging economies, we're seeing optimism has come down a little bit. Overall, what that means is we still will see reasonable or moderate economic growth out of the emerging economies, but not quite as strong as what we had been seeing. So put it all together, and we will probably still see moderate growth worldwide, but coming a little more from the developed economies and a little less from the emerging economies. We ask CFOs whether they're hiring full-time employees or maybe whether they're shifting away from that a little bit and emphasizing more part-time, temporary, or even outside consultant employees. And what we found is there has been a bit of a trend away from full-time and towards these other non-full-time types of employees. So we asked the companies, well, why are you doing that? What we heard is economic uncertainty has a lot to do with it. You have a lot more flexibility with temporary part-time workers and outside consultants. When the economy picks up a little, you can increase their hours, but if the economy starts to soften, you can cut back a bit. And so economic uncertainty is a big reason that companies have shifted somewhat away from full-time employment. And another is just cost. It's cheaper to typically hire part-time and temporary employees than it is a full-time employee. Another interesting wrinkle is about 37% of companies in the US said concern about the Affordable Health Care Act has actually caused them to hold back a little bit in adding full-time employees, maybe hire a little bit more instead on the temporary or part-time side of employment. And so you put those things together and we've seen a little bit of a shift away from full-time employment. Now, full-time employment has been growing, right? We actually expect about a 2% growth in employment over the next year, full-time domestic employees. But it probably would have grown a little bit more if we didn't have a little shift away from the full-time domestic employment. 40% of US companies say that the stock market is overvalued and they think we'll have a correction downward sometime in the next few months in the next year, okay? That sounds like a bad thing, right? Stock market going down. But fortunately, the companies are saying it probably won't affect their plans for the future unless, if the market correction is only moderate. Now, why is that? Well, if a company is getting ready to issue stock or use stock to make an acquisition, that could directly affect them if their stock price has fallen. But most companies are not in the mode to do one of those actions, and so they say they think they'll be able to weather a stock market reaction reasonably well over the next year. We've kept a close eye on interest rates. Interest rates have been going up over the past few months, and CFOs tell us they expect interest rates to go up by about 3/4 of a percentage point by the end of the year. So not a full percentage point, but getting close. That could affect the corporate sector because borrowing costs would go up, for example. Fortunately, most companies tell us they're somewhat immune to small to moderate sized increases in interest rates. So what we expect is companies will continue to more or less stick to their capital spending plans, for example, even if interest rates were to go up by about a percentage point. So that's really good news because we do expect interest rates to go up, but we don't think it's going to be a severely difficult problem for the corporations. This also gives the Federal Reserve a little more flexibility on when they want to start moderating the actions they've taken in monetary policy. So that's probably a good thing also. So interest rates going up, not necessarily a good thing, but we don't think it'll have a strong negative effect on the economy. Companies have actually, in the past year, been operating at a pretty high profit margin, and that's supposed to improve even more over the next year. In fact, we expect the return on assets, which is a common measure of profitability, to jump to about 10% by the end of next year. That will put it back up to where return on assets was before the recession. So full recovery for profits relative to pre-recession, which is really quite remarkable when you consider all the turmoil going on in the world, all the different things, the risks that potentially companies could face. They've done quite a good job of protecting the bottom line. And that's a good thing for the economy because some of that money will be returned to shareholders who can then spend it or reinvest. Some will be retained by the company who can use that to do business spending or maybe to hire more employees or to protect against future liquidity crises, whatever it may be. So profitability is actually looking pretty strong, which is quite a positive.